Hello and welcome to this week's edition of Wealth After Work, the show dedicated to bringing you in and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio, we have Josiah Grosso. He is the Vice President and Senior Investment Advisor at ASC Financial Group, and Senior Investment Advisor Taylor Munoz. We're so glad you're joining us today. The title of today's show is How to De-Tax Your Retirement. Yes, you heard that correctly. Just like we want to detox our lives from harmful substances, it is so important to take steps to start removing those harmful taxes from your retirement, and that's what we're going to be talking about today. But first up, Josiah, Taylor, so good to be back here with both of you this week. How are you?
Great to be with you.
It's been awesome. I missed you guys last week. I saw that you guys had a whole bunch of fun without me being here, but I'm glad to be back.
I mean, we moved me to the outside this time so that, as you know, Josiah is gesturing, I can make a quick escape if we need to.
Is that an Italian joke? I mean, come on here, Taylor. You know I can't talk without my hands.
We practiced social distancing before it became popular.
Right, yeah.
Just from a safety standpoint.
Because you're like, I didn't want to get whacked, right?
Right, exactly.
Oh, but we're so glad to have you back. And I know this is going to be a really fun conversation between all of us and with our viewers. You know, again, we're talking about how to de-tax your retirement. And there's a lot of talk out there about detoxing our lives. We want to remove harmful things like toxins from our lives. Well, guess what? Taxes are one of the most harmful things to the success of your retirement. So we're going to use this analogy throughout. So to kick us off today, we need to help folks understand that most people are headed into a retirement with a potential tax hangover. So that's my first question for you all today. What is this potential tax hangover, and what do our viewers need to understand about it?
Yeah, it's a great question, Kristen. You know, when we talk about a hangover, that really is something that lingers from the past.
Yes.
Okay. So now when we talk about the retirement hangover that we have, or the tax hangover that comes from our retirement, that's really where things could hit us harder than we expected here. So we think about most or majority of people have in their retirement accounts are in these tax-deferred vehicles, these IRAs, the 401ks, and the 403bs. And, you know, on average, it's about 80% of somebody's liquid net worth that are saved into these retirement accounts. And so while we were working, we were diligently paying into these retirement accounts. Some of the great things was we didn't pay tax on that money as we were putting it in.
Right.
And then any of the growth that we had on it, we didn't pay tax on that either.
Yep.
Unfortunately, that also meant we had a partner inside of these accounts, okay? And that partner is Uncle Sam.
Yep.
And we may not realize that we are actually paying potentially higher taxes that we never expected that we were going to. The whole idea behind this was now that we're no longer working, we're going to be lowered, we're going to be in a lower tax bracket. But many times that's not the case that we see in retirement.
Yes. And I was going to ask, why is that such a misconception for folks?
Yeah, so a lot of times it's the fact that we don't have as many deductions anymore. We may take, you know, maybe a little bit less income that we've been receiving, but the actual taxable portion, what we're able to actually bring home, could be just as high or as close to it. It is going to be a little bit different for everybody, but that's just something that we really take a look at. But here's the thing. Even when we now get to a certain age, even if I didn't need to take my money out at all, I'm now age 73. That means I need to start taking the money out. The government forces me to for something called a required minimum distribution. And here's the thing, that can have some huge effects. By taking that money out, that can throw me into a larger tax bracket. It could affect the taxes on Social Security. It could affect my Medicare premium that we have here. So the question is not if I'm gonna pay tax on this money. It's really more of a question of how much and when will I pay tax on that? And so that's why we talk about smart tax planning, some strategies we can utilize to kind of reduce or eliminate that tax hangover that we have. And here's the one cool thing, Kristen, and this is going to be for our viewers at home. Make sure you stay with us because we've got a powerful tool we're going to share with you on how you really can see how this tax hangover could affect your retirement.
Yes, the reality is taxes in retirement just get so much more complicated. And I think that's the problem, right? We've been told our whole lives, this is a really good thing for you. Put these money, the money into these tax deferred accounts. To your point, you get the tax break when you make the contribution. That money will grow tax deferred. And then supposedly in retirement, you should be in a lower tax bracket. But my goodness, we are over $36 trillion in debt. You mentioned some key areas of taxation that change in retirement. And Taylor, I'd love for you to expand on those. Taxation on Social Security, required minimum distributions, and taxation on your investment account. So talk about that.
Yeah, and I want to talk more about those misconceptions too, because a lot of folks think, and we have some clients I'll talk about in a moment like this, but some folks are fortunate or blessed to have enough coming in through their Social Security and their pensions. I mean, I have some clients right now that said, look, we have more money in retirement than we did when we were working from these guaranteed sources of income.
Right.
But they still have tax-deferred accounts, IRAs, 401ks, 403bs, several categories. But their tax-deferred accounts, when they hit 73, they still have to take that required minimum distribution, RMD, right? And a lot of folks aren't aware that they're going to be forced to begin pulling that money out.
Whether they need it or not, whether they want to or not, right?
And so in addition to that great guaranteed income, they're going to have that on top of it. It's going to push their income up. We actually have clients out of Belvedere, New Jersey. They were both teachers, Steve and Sharon. And they came to us and they had generous pensions from having worked as teachers. That was great. They have Social Security, but they also had IRAs. So while they had all of their, their everyday necessities covered from the guaranteed income, they still had to pull on those other accounts when they hit RMD age. So it really takes working with an advisor to help navigate the complexities of what to pull out from our accounts and where in order to try to mitigate the tax impacts of pulling from those deferred accounts. You mentioned Social Security. Again, a lot of folks don't realize that as much as 85% of their Social Security benefit can be subject to ordinary income tax, depending on their income picture. And most folks think, well, I paid the government when I was working. They withheld it from my paycheck, and now when they retire, they're going to get taxed on them beginning to draw on that benefit. So they paid on it while they worked, they paid on it while they're retiring, and the government, to determine how much you is subject to tax, takes half of your Social Security benefit and adds it to your adjusted gross income. So it's like this triple whammy for folks when it comes to Social Security taxation. So again, an area that we really need to be careful in and help guide folks through is the impact on Social Security. And I think the last area that we did touch on briefly is you have fewer deductions in retirement, right? So a lot of our clients, they've been diligent savers. They've been diligent about paying their debts off. They've paid off their mortgage. But the flip side is they pay off their mortgage. Now they don't have a mortgage interest deduction.
Correct.
Their children are grown. They don't have a deduction for dependents. And they, their retirement contributions, they're now retired. So they're not contributing to their accounts anymore. They don't get that pre-tax benefit. So again, if we're not careful, our taxes in retirement could be as high as or higher than when we were working. So that's what we really work to lead folks through and understand. And that's why our retirement income analysis is so powerful that we lead folks through. One of the big areas we look at when folks come in and meet with us, they come in for their retirement income analysis and we look at what are the tax impacts of your money. How are you positioned? What will be your required minimum distribution? And are you planning for having to take that money out? And what will be the impact on your other sources of income, like Social Security, when you have to pull out of those tax-deferred accounts? So if you're watching today and you think that you may be the victim of a tax hangover, and you're not sure the full implications of the assets that you have and how they're going to be handled and what the tax implications will be in retirement, how to efficiently draw on those assets, well, then you need to reach out to us. Call us at the number on the screen. Look at the QR code on the screen as well, and reach out to us so that we can get that custom analysis done for you. There's no obligation, there's no charge at all, it's complimentary, and it's just a powerful tool for you to use as you begin planning thoughtfully how to draw income on your retirement assets when you're now retired.
Wonderful. Taylor, Josiah, thank you so much. And how to do so in the most tax-efficient manner possible, right?
Exactly.
So to our viewers at home, that number to call to schedule your time to come in and receive that retirement income analysis, it's there for you on the bottom of your screen. Simply dial 844-918-4867. Or if you prefer to connect online, you can simply scan that QR code down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from ASC Financial Group will reach out to connect with you to schedule that complimentary retirement income analysis that way as well. Don't go anywhere. We've got a lot more to talk about on how to de-tax your retirement, including the de-tax plan that the team of ASC Financial loves to walk folks through, and a very special resource that we're going to be sharing with you, our viewers, today. Stay with us.
I started the business back in 2005 as a legacy for my family, and I'm blessed to have two of my sons working with me.
ASC Financial Group, it's a family-run firm where we are focused on income, not just growth.
Many people can't say that they're able to work with not only their father, but their mentor and their best friend.
My main objective when I meet with someone is building a relationship, building trust.
All of the advisors and the staff, we're all listeners. It's not about telling people that come through the door what concerns them. It's about listening to them and really vetting what their goals and dreams are. We want our clients to feel like family, just like we are family within the practice.
And that's what we want to provide for our clients.
Welcome back to Wealth After Work. I'm Kristen Oakley here with both Josiah and Taylor from ASC Financial Group. We're so glad you're joining us today. If you're just tuning in, we are having a very important conversation all about how to de-tax your retirement. Yes, just like we want to detox our lives from harmful substances, we got to get those harmful taxes out of our retirements. And really, it's been said that success in retirement isn't about how much you have, it's about how much you get to keep. And that's one of the biggest detriments to retirees is taxation. And it's not talked about enough, but I appreciate that you and the team are proactive and you look ahead and engage in this proactive tax planning with your clients. There's a lot of potential pitfalls for retirees that a lot of folks are not aware of, contributing to that potential tax hangover we talked about earlier. I know you wanted to go into a little more depth on some of them.
Yeah, I think we really want to just touch on Social Security again. You know, again, Social Security makes up as much as 40% of most folks' retirement income on average, right, when they look at national averages. So it's really important to understand the tax ramifications and how much of your Social Security benefit could be subject to tax. Right. And you know that tax threshold is as high as 85% of your benefit being subject to your income, ordinary income tax. And I think what some folks find disturbing is that the Social Security uses a formula they call provisional income, right? What's your provisional income? So they take your adjusted gross income. So in retirement, what's your income? It's what you get from a pension. It's what you pull from your tax-deferred accounts, your IRAs, your 401ks, your 403bs. Right. They take all of that, and then they say, well, now we're going to add half of your Social Security benefit to that, and that amount is going to determine how much tax you pay or how much of your Social Security is subject to tax. And so the thresholds aren't easy to hit. We've talked about this on previous shows. It's easy to hit some of these thresholds because they've never been adjusted since the 1980s when they were first put in place. If they adjusted those for inflation, they'd probably be potentially 2 to 3 times higher today, but they're not. Right. And so if you're single and you make over $25,000 a year, or you have that much in income coming in, then up to 50% of your benefit could be taxable. If you're married and filing over $32,000 a year, 50% could be subject to tax. If you are single and you bring in $34,000, or married and you make over $44,000, in whatever that retirement income picture is, up to 85% of that benefit could be taxed. So it's important to understand all the nuances that go into understanding how the Social Security picture fits into your taxable income.
For sure. Bottom line, taxes don't disappear in retirement.
They do not.
Right?
There's two guarantees in life, Kristen, death and taxes.
Exactly. But I think the issue is some folks then assume, well, there's nothing I can do about it, right? And we're going to continue to share solutions throughout today's show. But before we get to that, required minimum distributions, I know you wanted to touch on a little bit about those too, how that compounds the problem.
Yeah, those required minimum distributions, Kristen, start at age 73. And here's the thing, even if we don't need that money, we're required to, because if we don't, Uncle Sam says you now have a 25% penalty and still have to take that money out and pay tax on it.
Exactly.
Right?
Yep.
And so what does that mean? What does that mean that's going to happen? So by taking out that income, maybe when I retired, I was in a high-paying job. I don't need that amount, so I'm just collecting my Social Security, maybe small pension. That's all well and good. But now I'm 73 and I've amassed this large retirement account. Remember, the larger these retirement accounts are means the more I have to take out. I'm required to. So what does that mean? That can throw me into a higher tax bracket that I wasn't expecting. We talked about why the reason of that was maybe not as many deductions.
Right.
Okay, so that's the concern. And then the other thing we talk about here is that Social Security. Maybe that's the trigger that throws me in that provisional Social Security amount that we have, okay? And now up to 85% of my Social Security is gonna be taxed, okay? And lastly, we have here, I touched base on it a little bit earlier, but the Medicare premium. And I'm not talking about the Part A. This is the Part B that we have to pay for, okay?
Yep.
So that's the income-related adjustment amount, IRMA. Okay? We always use these little initials for everything together.
Yes.
Acronyms. So this IRMA. So now let's just say I'm getting the regular Part B at $185. And now I've got to take out this large amount for required minimum distribution. And it's thrown me not only to a higher tax bracket, more provisional income for Social Security, up to 85%, and my Medicare premium can now increase by $75, $185. The top bracket is an additional $450 for Medicare premium. And that's why we often say that the most amount of money we receive from Social Security is generally from 67 to 72 before RMD start, because all of that money comes out of our Social Security.
Right.
So that's why it is so important, Kristen. We've really got to talk about how are we planning for these RMDs. And so, folks, if you're at home here, no one has talked to you about what's the situation, what's the problem, what are the issues of taking out the required minimum distributions. If you don't know how your Social Security is going to be taxed, if you're not sure how that money is going to throw us into a higher tax bracket, I'm going to encourage you to pick up the phone, give us a call at the team of ASC Financial Group. We're going to help walk you through some of these tax liabilities, some of the things that we can do to reduce or even in some cases eliminate some of these huge tax burdens. So pick up that phone, give us a call at that number below.
Wonderful. Josiah Taylor, thank you so much. To our viewers at home, that number to call to schedule your time to come in and receive this complimentary retirement income analysis is 844-918-4867. Or again, you're welcome to scan that QR code and that will get you connected as well. So far today, we've talked a lot about the problem. When we come back, we're going to be diving into the solution and sharing with you a very special resource that previously was only available to existing clients of ASC Financial Group, but we are going to extend it to you completely complimentary, our television viewers. Stay with us to find out how you can de-tax your retirement right after this.
Have you ever taken your family to dinner and been shocked at how expensive the bill was? Well, right now, there's over $22 trillion in the United States in tax-deferred retirement accounts, like 401ks and IRAs. Do you have one? Hi, I'm Taylor Munoz with ASC Financial Group, and I want you to think right now about how much you have saved in your tax-deferred retirement accounts. Let me tell you something. That's not all your money. You've got to pay tax on that money as you withdraw it in retirement. At ASC Financial Group, we have created a tax test calculator to show you what you will pay in future taxes on your retirement accounts. And it's free for you to use. Go right now to ASCtaxtest.com. you are going to arm yourself with some knowledge about your future taxes and then reach out to us. We can help you build a strategy to have a plan for yourself how you can lower that tax bill. Go right now to asctaxtest.com.
Welcome back to Wealth After Work, where today we are discussing how to de-tax your retirement. If you're just tuning in and joining us, we've talked a lot today about the potential tax hangover that most folks are headed into retirement with and may have no idea about. It's a huge problem, but just like a good detox requires a structured plan, so does de-taxing your retirement, and that's what we're going to share with you now. And before the break, we mentioned that we have a very special resource that we are going to be sharing with all of you today that you can use in real time, completely complimentary. So I'm excited, Josiah and Taylor, for you guys to walk us through and our viewers what the solution is.
Yeah, so Kristen, we wanted really a clear-cut, straightforward tool to really show our clients and any of our viewers at home really what this tax hangover is going to look at, okay? And so we developed this website, ASCtaxtest.com. We've got a little QR code people can scan and look at it right now. And here's going to be some of the amazing things. Once you go onto this site, okay, what you're going to do is you're going to fill out your information, okay? You're going to put your name, you're going to put your date of birth, your email address, which is really going to be important in order to receive this report. We also have some of these sliders at the bottom here that you can change what you think your tax rate, if you think tax rates are going to be lower or potentially higher in the future. Also, you're going to be able to say what your adjusted rate of return is. And then here's the key. We're going to take all of our retirement accounts, all of those IRAs, 401ks, 403bs, put them all together, and we have a number, and we're going to click submit.
Okay.
And now here's the great thing. We're going to get this side-by-side comparison that's going to show us exactly what the government's tax plan for you if you do nothing, or if you take some proactive steps to be able to reduce, or in some cases, drop that tax rate down even lower from here. And I think finally, we've even got a screenshot of the detailed report that we have here. And this is really going to be where all the numbers are going to be put together that you're going to be able to see. And so we take all these factors, we put it together. This tool is just absolutely amazing that really will demonstrate what your tax hangover is in retirement, and that we can see it in black and white numbers exactly what the effect is.
Yes, thank you for walking us through that. So if you've not yet done so, we encourage you, pick up that smartphone. What are you waiting for? Visit that site, ASCtaxtest.com, or scan that QR code. As Josiah said, you're going to be able to receive this report with your numbers and that breakdown for you. And if we could, I want to go back to that report slide here just to show the screenshot. This is one page of that report that you're going to receive. And what I think is so amazing in this example, this person had $500,000 saved up in tax-deferred accounts. They were assuming a 22% tax liability. I believe is that an 8 or a 6? My eyes are failing me here on the assumed growth rate. But look at the difference down at the bottom. I mean, it's a difference between if you do nothing, the government's tax plan for you, what you'd be settling for in this example, over $700,000 worth of tax versus only paying $110,000. When you see that, you can't unsee that. And I guess my next question is, when folks have been filling these out and coming in a meeting with you and saying, help, I mean, are they just completely shocked at the difference between those two numbers?
They are. I mean, it's staggering. It's staggering, and we walk folks through all of the strategies that are available to them to start mitigating that tax impact.
Yeah. So let's talk about that. We got to talk about the solutions.
Yeah.
Right?
There's a lot of strategies that we can look at. A myriad of strategies to help offset some of those taxes. One of the big ones that we hear a lot and that we work with a lot of folks to do is a Roth conversion. You know, simply put, a Roth conversion can be described as buying tax-free wealth at today's tax rates. Right? So especially when you have historically low tax rates today, especially if you, the viewer, think that tax rates are going up in the future, then now is the time for you to essentially get the government out of your business and start transitioning towards tax-free, because we know that Roth monies, when we've gotten the government out, we've paid that tax, a Roth account grows tax-free. It's distributed tax-free when we pull money out, and it's inherited tax-free when we die. So our loved ones get a balance that they don't have to pay the government, a significant tax upon the death of a loved one. So there's a lot of benefits, and I know Josiah's favorite analogy is it's like, how do you eat an elephant, right? It doesn't have to be all at once. You just take one bite at a time. Very similar if you have an IRA or you have other tax-deferred monies, you don't have to convert it all at once. But it may make sense for you to start partitioning that into little pieces and working, intelligently and intentionally through a process of converting some of that now. So that's one of the big strategies that we look at, and we've led a lot of folks through the process successfully in doing. Another strategy, tax efficient withdrawals we talk about. You have kind of three categories. And our retirement income analysis lays this out. It looks at how are you diversified according to tax. You have tax deferred, which is the majority of most folks' retirement income or monies as they come into retirement. You have taxable, right, which would be a brokerage account or just an investment account. That's not an employer-sponsored account. And then you have tax-free, which would be Roth. And so we look at how do you best draw from those accounts in a way that keeps your tax load as stable as possible as you go throughout your retirement years. And one really creative strategy that we really enjoy working with folks on, and not everybody is fully aware of this strategy, is called the QCD. Another one of those fun acronyms, right? Qualified Charitable Distribution. When you hit 70 and a half years old, you have the ability to make contributions out of those tax-deferred accounts to the charity of your choice, a 501c3 organization. And again, we have clients that came to us, they had all their regular expenses and then some covered through guaranteed income. They still had IRAs they had to draw out of, and we were able to work with them on a strategy where the charities that they would have given to originally anyway, including their church, they were able to make those contributions directly out of their qualified account, their IRA. And it was a donation to the organization they wanted to go to. And it satisfied their RMD, and they didn't have to pay tax on that money. So why take the money, pay the tax on it, and then write a check when you can take the money out of the tax-deferred account, send it to your church or whomever you direct it to, and not have to pay the tax? It really helps mitigate that tax load for some folks.
And it's a win-win because the charity gets the full amount. So, I mean, it's a win-win for both involved.
Yeah, so there's a lot of power in some of these strategies. And that's where we just, say if you're just tuning in, and we were talking about it earlier, we talked about this ASC tax test website that we've created for you to be able to go through and really take an intelligent look at your tax picture. We encourage you to visit that website, and please reach out to us so we can lead you through that retirement income analysis, so we can show, are you maximizing income, are you reducing risk, and have you handled the tax implications of your money effectively as you head into or continue into retirement.
Wonderful. Taylor, Josiah, thank you so much. Thank you for joining us. Be safe, be happy, be blessed. We look forward to being back with you next time here on Wealth After Work.